Hey, hi everyone. Welcome to Investment Basics. Today I'll be sharing a guide that is aimed mainly at beginners who are not very sure how to start when it comes to investing. They are not very sure what are the different forms of investments that are out there. Along the way, I'll also be addressing some misconceptions that people have about investments. And also I'll be sharing my own personal journey later on towards the middle part of the video. Let's begin, shall we? The first question that we need to ask ourselves is why invest? Why do we want to invest our money in the first place? Well, number one is most people will want to grow their money. You want to turn, for example, $10,000 over time through the power of investment, it increases to about 30,000 over a period of time. Investment is something that doesn't happen overnight. It takes time, it takes effort along the way. All right, but of course, as you can see your money grow, it's a very satisfying feeling. Number two is we also want to stay ahead of this thing called inflation. In Singapore, the inflation rate over the last 20 years, on average, if we average it out, is around 2.8 to about 3%. So what this means is that every year, you can expect that the cost of living or the cost of goods to gradually increase over time. What this means to you is that over time, if your income or your investment does not increase, your purchasing power with the same amount of money over a period of time, you have less and less purchasing power. That means you can buy less goods and services with the same amount of money. All right. Number three, you want to fund for major life goals. For example, you want to invest, you want to save for your children's education, you want to grow a certain sum of money so you can get there sooner rather than later. Or you want to save up for your personal retirement so the day you decide to stop working or the day you leave your job, you have sufficient money available set aside. And lastly, you are looking to possibly create, additional income streams through the power investment, where you can earn some rental income from property, or you can earn some dividends that you receive every month, so it help you to supplement extra cash flow coming in every single month for you. Let's look at some of the different types of common investments that most people are familiar with. In this example, I won't be going too much into detail about each individual asset class, but rather I give an overview, a bit of a pros, some cons of each different asset class, so at least you have a better understanding. The first type of investment that I like to look at is this thing called stocks. I think most people are familiar with it. They might have heard about it in the news. They heard about it from friends, family members. Invest into this company, buy this stock. This company is sure to go up. Of course, that's what we hear, but we also have to do our own diligence, our own research when it comes to this, because even though the stocks can go up, if you start you buy in a low price and it goes up, you make the difference. But in times of volatility, you might also lose that same amount of money. So please do your own diligence. For example, some people like to buy into Nvidia stocks, a very popular stock. You can buy into Apple stocks, Google stocks, but you have to do your research. You need to know when's the right time to go in, when's the right time to exit, and then you might be also subject to market volatility. And one thing to take note of as personal investors, we are also competing against professionals who are investing full time into these kind of companies. All right, so these people have supercomputers, they have the resources available for them to know when to enter, when to exit, when to change, when to go in. So we don't have that available as most normal people have. So you do have to do quite a bit of research to make sure that you're investing into the right company. Don't make the mistake of investing to the wrong company and regretting later. Let's look at another asset class called bonds. Bonds is for more conservative investors who prefer a more stable kind of investment. Where there's not so much market volatility. Of course, for example, a good example would be our Singapore savings bonds, where the returns are around 2.5% to about 3.5% every year. Not super high, but at the same time, it's generally very stable. Very stable. So it's good for people who are afraid of volatility. They don't like risk. They want something that's safe, secure, stable, even though the returns are slightly lower. One con about bonds is that over time you may lose to inflation. In Singapore, like I mentioned just now, inflation is about 2.8 to 3%. So if your bond value is growing at about 2.5 to about 3.5 every year, you are barely keeping up with inflation. But this is another asset class for people who are generally more conservative. The next asset class is called mutual funds. So mutual funds and unit trust is the same thing. It's just two different terms. So you might have heard of this term before. Unit trust, mutual funds, they're actually the exact same thing. And what they do is they actually made out of a combination of different companies put into one form of investment. So for example, you can have 100 companies into one mutual fund. You can have like Apple, Amazon, Nvidia, Microsoft, all inside the same mutual fund. All right. So usually mutual funds are professionally managed by a fund manager. So there's usually someone to look after it for you. All right. But of course, along the way, there might be management fees that you have to pay. So in this case, it's a more of a hands-off approach for people who are not very sure where to start. They prefer a more hands-off approach. You don't want to be looking at the investment every day. They pay a management fee and let someone manage it for them. So this is a very diversified approach when it comes to investing because you're invested into different multiple companies instead of just one company stock. ETFs, which stands for Exchange Traded Funds, is another type of investment. So in this case, we are investing into this thing called the index. What is an index? An index fund is basically the same name as an ETF. So in this case, for example, you might be investing into this thing called an S&P 500, which is made up of the top 500 companies in the USA. So when you invest into the S&P 500, you're investing into the collective performance of all 500 companies. So generally, when we invest into the ETFs, the performance has been quite decent over time. As long as these companies make money, you should see the investment go up. Of course, ETFs are DIY. It would mean that you will need to know how to invest on your own. You will probably need to set up a brokerage account to get started on your ETF journey. And when withdrawing money, sometimes there may be currency exchange risk, especially when the ETF is located overseas, and there might be some tax implications when trying to take your money out as well. So do your own due diligence when it comes to investing into ETFs. Okay, so let's look at Singaporeans' favorite form of investment, property. So in a lot of Singaporeans' mind, we feel that property is a very safe, a very secure asset that over time it's 100% bound to make money. Okay, that's what we think. And a lot of times we hear sensational news saying that there's a record price sales of a property. And over time, there's also a potential for large capital gains, especially for first-time owners who buy a HDB or an executive condo, which is heavily subsidized by our government. Eventually, when you sell the property, we tend to make quite a large amount of money that make the difference. All right. The thing about property is that we have to understand that it's even though the potential for appreciation is high, all right, and we can get some rental income if we rent out the investment property, there's a lot of high upfront costs when it comes to property. You have to pay for agent fees, you have to pay for stamp duties, you have to pay for legal fees, and there's a lot of ongoing maintenance costs, especially if you're renting out as well. And when it comes to selling of a property, it's not so simple. There's a timeline. It will not be instant. You will not be getting your money instantly. It can take a few months before you actually receive the sale of the property in cash. And that's when it becomes liquid. Okay, so we have to take note of that. Now, the last type of asset class I'd like to talk about is this thing called cryptocurrency. So cryptocurrency has grown in popularity over recent years, and the potential for returns is very high, especially if you're an early adopter. That means you're someone who started out your cryptocurrency journey early on before it became popular back in the early 2010s. Okay, it's very accessible for anyone with the internet. However, you have to make sure that when it comes to crypto, the price can swing up and down very much like a roller coaster, very, very volatile. And unfortunately, it's not widely accepted as a payment method in most places yet. And you also there's the risk of hacking or losing access to your account, which means that the value of your investment could also potentially disappear overnight. Very, very risky investment. I wouldn't recommend this to most beginners. If you wanted to, maybe put a small little amount just to dabble in it, but please don't put your life savings into cryptocurrency. Now that we have gone through the different types of investments and why should we invest, let's look at how to get started in investing, because we might have all this knowledge. Okay, we know about this product, but how to start, right? How to start? All right, so I think the first step is we have to assess. Number one, we have to assess our own financial situation. Do we have the means to even invest in the first place? Have we already set aside our emergency fund so that whatever balance that we have, this is extra money that we can use to grow? How is your cash flow? You have to ask yourself, how is your cash flow every month? Are you living paycheck to paycheck? If your cash flow is very tight every month, you barely have enough, you're just barely making ends meet, then investing might not be for you. You do need to have a surplus amount of money to even begin your investing journey. Number two, set clear investment goals. Before we even begin, we need to have an end goal. What is the objective when we want to invest? Are we investing so we have more money for our kids' education? That's what some people want to do when they want to invest. Are you investing so you got more money for your personal retirement when you turn 55, when you turn 60? So when it comes to investment, we need to have a long-term perspective rather than just want to see quick returns. The next month we want to see quick returns. We need to have a longer term perspective, a longer term time frame, a reasonable time frame to allow the money to grow. Okay, so start with the end in mind, then we can work backwards. Okay, so don't just invest because you feel like investing or you see other people investing. Invest because there's a purpose. Okay. Number three, determine your risk tolerance. With that said, everyone wants higher returns, right? But not everyone can stomach the risk that may come with it. So for example, if the stock market drops, will it give you sleepless nights? Will it make you feel uncomfortable that it starts to make you feel stressed out? So if you don't feel comfortable, go for something a little bit slower, a little bit more conservative, maybe like bonds, our Singapore savings bonds, treasury bills issued by our Singapore government, fixed deposits, something a little bit less volatile. All right, so you have to be able to know how to choose the right investment that suits your kind of personality and your own comfort level. Number four is probably something that I like to educate a lot of my clients. Don't jump headfirst into any kind of investment. Before you start, talk to someone, at least understand what you're investing into. Speak to someone that you trust, speak to a trusted advisor. Don't feel pressured to making any kind of decision on the spot. Especially if you get stopped at a roadshow or someone approaches you to sign up for any kind of investment with a promotion. All right, take some time to think, especially for elderly folks who are visiting the bank. Sometimes the relationship manager may try to sell you an investment product without fully considering your situation. So always give yourself some time and space to think about it. All right, do some research, educate yourself, speak to someone you trust before making any kind of investment decision. Like a famous person once said, Albert Einstein, compound interest is the eighth wonder of the world. He who understands it earns it, but he who doesn't, pay it. So what does he mean by pay it? So if for someone who doesn't know how to understand or to know how to make their money grow, over time they're actually losing out to the silent enemy and the invisible enemy called inflation. We don't see it, we don't feel it, but it's there. It doesn't mean it doesn't exist. Inflation is real. So one of the ways I can possibly suggest is always start small when it comes to investing. It doesn't have to be a big amount. A little bit each month you add up in the long run. So bit by bit, slowly, over time, you'll see your investment grow over time. And of course, lastly, when it comes to how to get started, when it comes to investing, is we have to know how to monitor and adjust our portfolio depending on the market condition. Now, when it comes to this, a professional can do it for you, or you can do it yourself. Of course, if you do it yourself, you need to know how to do it yourself. So don't just leave it there. Don't just leave your investment there and you hope and pray for the best. Hoping and praying isn't an investment strategy, unfortunately. So if you're someone managing it for you, like an investment team, a full-time investment team, great, very good. They help you to do all the hard work so you can fully focus on the things you enjoy. So not everyone has this privilege of someone managing their portfolio for them. So understand what you are buying so you can make changes as and when needed, especially when it comes to your own DIY stocks. For the last part of today's session, I would like to share a little bit about my own personal investment journey. This is a snapshot of one of the investments that I have. I won't be showing all the investments because this is just one of them that I feel I would like to share with you guys because I've been very consistent with it over time. I'm sharing this not to impress or to brag or to try to show off to anybody, but rather to make a point that to grow your money, it takes time, it takes patience. It's not something that happened overnight. It took me many years. But of course, at the end of so many years, I can finally see the results of all my effort. Okay, so maybe just a bit of background about my investment journey is when I've been in the financial advisory space for the last 9 years. All right, in April 2017. Okay, that was about when I was about 1 year into my financial advisory career. I had some savings that I already built up over time. All right, from my income, from some of my savings, and it was about $39,000. All right, so I decided to put this $39,000 into an investment. I put it into a unit trust, a mutual fund that is fully managed by my company's investment division. So at the time, you can see over here, let me take out the highlighter. Okay, over here, I put in total about 39,000 in 2017. Okay, and I left it there. I didn't touch it all. Okay, but what I did was every month I decided to be very consistent. I decided to start investing about $500 every single month. You can see over here, $500. Okay, and I did it for many years. Every single month I'll just be very diligent. $500, $500 all the way for many years. And let's fast forward to 2023 and see what's the performance like. Now, this investment is fully managed by my company's investment division. That means they help to rebalance the portfolio, they help to monitor it, they help to make sure that it adjusts based on market condition. So we are not hoping and praying that it magically goes up. All right, that means there's a full-time professional team looking after the investment for me. Of course, I pay a small fee to them every month, but this gives me a lot of peace of mind. So it takes my mind off the stress, all the hard work of having to research the market 24/7. And I do this for my clients as well, so they can focus on the things that they truly enjoy. They don't have to stress about what's going on around the world, what's happening in the markets. Okay, so we do all this for them. So over here you can see for my own personal investment, I've been investing $500 every single month. And in 2022, when the market dropped, I had some savings available. I decided to put in about 20,000, all right, when the market actually went down. Okay, fast forward to 2024. I actually decided to take a break in 2024. I decided to pause my investment. It's flexible because I realized that at that point in time, I had some marketing commitments that I wanted to embark on. So I decided to take a pause for my investment. All right. But now in 2025, I have started my investment again. Okay, I started my investment again. So now I have started to increase the amount from 500. Now I've increased it to $1,000. Okay, so let's look at the current value. So over the last, since 2017 all the way until 2025, close about 8 years of investing, let's look at how much the investment has grown. All right, in total, over time, even though I put in very gradually, in total I put in about close to about $96,000. And the value today is about 134. So not too bad, it went up close to about $37,000. I mean, $37,000, pretty decent sum of money. For me, I basically did nothing. I did nothing. I just left it there and let the professionals manage it for me. And I think $37,000 in my mind, I can do quite a lot of things with it. I can go for quite a number of holidays, or now I have extra money that's already set aside for my own son's education. So I'd like to end off by saying that when it comes to investment, it's all about consistency, time, and patience. All right, it didn't happen overnight. I did not magically get a very high return overnight. It was a lot of consistency, $500 every month over a period of time. And this is an investment portfolio into mutual funds, like I said, fully managed by my company's team. And over the years, they did a lot of tweaks to the portfolio just to stay up to date with the market conditions. So we weren't just leaving it there hoping and praying that it did well. So again, I'm not showing this to brag or to show off, but rather emphasize that growing our money when it comes to investing, it requires patience. It takes time, and only invest with money that you don't need for the short term, but you want to grow for the long term. So have that mentality when it comes to investing. It's money that you don't need right away, because if you need money in the next 1-2 years, then my suggestion is don't invest at all. Just put it inside the bank or put it in something that is very easily accessible so you can take it out anytime you need it. Thank you very much for watching. I'll be releasing a part 2 of this video on investment basics for beginners. If you have any questions or you'd like to connect with me, you may scan the WhatsApp QR code or email me at hello@matthiasyeo.com. If you'd like to find out more about me, my services, my values, my client experiences, do check out my webpage, mattiasyeo.com. I'll see you in the next video. Thanks. Goodbye.